Friends, welcome to Yadnya Investment Academy. In separate videos, we have seen what is a bonus share issue and what is a stock split. In this video, let us compare these two to understand these concepts in detail. Let us understand these two with the help of an example. So before declaring any sort of bonus share or stock split, let us say you have 100 shares of a certain company. These shares have a face value of 10 rupees each. The current market price of this share is rupees 120. So current value of your investment would be market price into total number of shares. So that is nothing but 12,000 rupees. And there are 10 lakh shares of this company in the market. Market capitalization is nothing but the market price of the share into total number of shares. So the current market capitalization of this company is 12 crores. In case of a bonus share issue, the company issues new shares in the announced proportion. So let's say if the company announces a 1:1 bonus share issue, you have 100 shares already. The company will now give you additional 100 shares. In case of a stock split, your same share is going to be divided into multiple shares. So for example, let us say the company doesn't go for a bonus share issue, but it goes for a 2:1 stock split. What it means is that your every stock would now be divided into two stocks. So since you had 100 shares before, after the stock split, you will have a total of 200 shares as each share is now divided into two stocks. Now here we'll be comparing 1:1 bonus share issue with 2:1 stock split because at the end of 1:1 bonus share issue or 2:1 stock split, your total number of shares would be the same. In case of a bonus share issue, the face value of the stock is not divided. You are issued new shares with the same face value. Whereas in case of a stock split, the face value also gets divided in the same proportion as the stock splits. So here, the face value would be divided by 2 in this case. In case of a bonus share issue, the market price is reduced in the same proportion in which the number of shares increase. So here in case of 1:1 bonus share issue, your shares have doubled and so the market price would be halved. In case of a stock split, the market price is split in the same proportion as the stock splits. So here the stock has split into two. So the market price would again be divided by 2 and so the new market price would be 60 rupees. Your value of investment remains same after a bonus share issue or a stock split as the number of shares rise in the same proportion the market price reduces. And due to the same reason, market capitalization of the company remains same after a bonus share issue or a stock split. Share capital is the amount of money collected by the company by issue of its shares. It is calculated by multiplying face value to total number of shares of the company. So here, since the face value was rupees 10 before the bonus share announcement or stock split and the company had 10 lakh shares in the market, share capital of this company was 1 crore. In case of a 1:1 bonus share issue, since the total number of stocks double and the face value remains same, the share capital also doubles. But as these bonus stocks are issued to the investors at no additional cost, what the company does at the back end is it shifts 1 crore from the reserves of the company to its share capital. Reserves is nothing but the amount of money kept by the company to run its day-to-day activities. If the reserves of the company before 1:1 bonus share issue was 5 crores, after the bonus share issue, the reserve capital would reduce to 4 crores. But in case of a stock split, as the number of stocks go up, in the same proportion the face value is also reduced and so the share capital remains same and so does the reserve. Let us see how capital gains would be calculated in case of a bonus share issue and in case of a stock split. Now the market price of the shares after the bonus share issue or the stock split is rupees 60. Let us assume that the share price increases to rupees 90 and you decide to sell your shares. We know capital gains is calculated by subtracting acquisition cost from your selling price. So your selling price is your first 100 shares into 90 plus your 100 bonus shares into 90. And the acquisition cost would be your first 100 shares into 120 was your acquisition cost, and as bonus shares have been issued at no additional cost, these bonus shares would be multiplied by 0, and your capital gains thus work out to be 6,000. Whereas in case of a stock split, the acquisition cost also has to be divided for each share. So acquisition cost was 120 rupees earlier. So the acquisition cost would be reduced to 60 rupees, and this is how the capital gains here also work out to be 6,000. Similarly, another scenario wherein the price of the stock rises to 150, that is above 120, and you decide to sell your shares. In the same manner, these calculations have been represented here. So this is what happens technically. It hardly matters for the investors or the company whether the company goes for a bonus share issue or a stock split. The company goes for a bonus share issue or a stock split only to increase retail participation. So friends, that was all on this difference. Hope the video has been useful. Thanks for watching this one. Watch this space for more such topics. If you have any questions, do let us know in the comment section below our videos. And if you like our videos, please do subscribe and share. And now before we end, we want to let you know that you can create your financial plan for free on our new portal. Our new portal is investyadnya.in. So please try it out. And you can buy our first book, which is a collection of 108 questions and answers on mutual funds and SIP on Amazon, Flipkart, etc. The link to buy the same is mentioned in the description of this video. So see you in another video. Until then, happy investing.